Hi, I'm Jenny Brown. Welcome to this week's MFB news. I hope you are doing really well. I hope you've had a fantastic week. Busy with us. I spent yesterday at the Landlord investor show in London, catching up with loads of lovely landlords, and I'll fill you in a bit more about that later on. And we've been just really watching the markets very closely to see what's going on with that as well. So more on that to follow also. So what we've got for you today, so we're going to do our usual roundup of what's been happening with the lenders, let you know where pricing is currently sitting. I've got a positive lender change in terms of criteria to share with you. These things are to be celebrated no end at the moment. So I'm going to update you there. We're then going to talk about the rental market. There's been some data that's been released in terms of what's happening and the impact of the changes. And then finally, we're just going to touch on the new mortgage or landlord lender charter, which is designed to help those people who are facing financial difficulty, particularly in wake of the higher cost of living costs and also mortgage interest rates, really just lay out how that works and how it may be of use to you or one of your peers. Okay, so mortgage rates, what's been happening? So unfortunately, another week of increasing. We've seen swap rates go up again. Now, not dramatically so, some of the largest shifts that we've seen in the last few weeks, but there has been an increase nonetheless. So last week, they were hovering at around 5-year swaps were at around 5%. They're currently sitting as of 10:30 last night at 5.059%. For comparison, 1 month ago, 4.475. So they've increased by circa 30 basis points. 2-year swaps feeling very elevated at the moment, 5.930. Compared to 1 month ago, we were looking at 5.201. So yeah, things have definitely increased. Things aren't moving in quite the same kind of manic fashion that we were seeing a few weeks and months ago. So that's positive. But what we haven't seen is obviously things start coming down. And as I've mentioned in previous weeks, I don't think we're going to really see that now until probably towards the end of the summer. It's just really a case of how far these things keep pushing up. Now, in terms of how that's shaking out in mortgage pricing, just looking at personal borrowing first of all, 2-year fixed rates, 4.5%, but with an enormous fee of 5% or 5.03, rates from 5.03 with an arrangement fee of £4,000. And there's lots of kind of stuff in between and beyond that as well. So there are, for example, 2-year fixed rates with no arrangement fee whatsoever. So there's a kind of, a scale essentially. 5-year fixed rates, personal borrowing, standard properties, from 4.78% with a kind of more palatable, should I say, £1,395 fee. Variable rates, these are back on vogue at the moment. People seem to be more interested in these. Again, I'm going to reiterate this because we had a bit of an issue with this last time around after the mini budget when people were looking at discounts and trackers. They can go up, they will go up. So please, if you go for one of these because you're kind of enticed by the, maybe sort of lower rate, you're of a belief that interest rates will come down over a 2-year period. There's nothing wrong with that school of thought, but you have to kind of accept they're also going to go up in the short term. So variable rates from 5.09 with a 4% fee or from 5.24% with a 1195 fee. Now, in terms of variable rates, there's a difference, there's different type of jargon, and I guess it is kind of jargon that's used within the industry because you have tracker rates, discounted rates and variable rates, a terminology that you'll hear bandied around. Now, in our kind of space, mortgages for business, the way we define things, so a tracker is tracking the Bank of England base rate. So, for example, if the wording was base rate plus 0.5%, currently you're paying 5.5% because base rate is 5%. If base rate moves up to 6, you pay 6.5%. But also, equally, if it drops down to 4.5%, you'd pay 5%. So it's literally following the Bank of England base rate. Now, discounted rates and variable rates are not linked to Bank of England base rate. They tend to be linked to the lender's own in-house standard variable rate. And these standard variable rates don't tend to be directly linked to Bank of England base rate. So the more cynical amongst you would say that every time the Bank of England pushes its base rate up, the variable rate increases. But when the lender drops its variable rate down, the Bank of England drops its base rate down, the lenders aren't quite so quick to jump on the reduction. There could be some truth in that, I don't know. But the reality is that if you're looking at discounted rates, the Bank of England base rate, while it would be a good kind of guide for you in terms of what your mortgage rates might do, they're not actually directly correlated. So there might be an increase in base rate. The lender might do nothing for a few weeks and they make a change which is directly proportional or different. So it just can vary. So just be aware of that. Now, in the specialist space, how the pricing is shaking out at the moment. So 2-year fixed rates from 4.5% with a 5% fee or from 5.74% with a 2.5% fee. On those big fees, something just to be careful of. If you're looking at a product as such, you do just need to ask the question, you've told me my maximum loan amount is however many thousands of pounds, can the arrangement fee be added on top of that, or is that included within it? Now, this is often something which is because different lenders have different rules on this, and it is quite confusing. If you're taking a mortgage and there's an arrangement fee of £1,000 and you're hoping to borrow 200,000 and ultimately you can only borrow 199,000 because you have the £1,000 arrangement fee, which is made up of that, it's largely an amount of money that you can live with. But when we're talking about the arrangement fees of 5%, and if you're looking to borrow, say, £200,000, and then suddenly you've got to find £10,000 from somewhere because the 5% fee comes out of that, and that can cause you a real problem. So when you're looking at these products with the large arrangement fees, do just ask the question, is this in addition to the loan amount, or is this included in the loan amount, so you understand what you're kind of in for? So like I say, 2-year fixed rates with a 5% fee from 4.5, with a 2.5% fee from 5.74, 5-year fixed rates from 5.09 with a 7% fee, or from 5.75% with a 3% fee, and your variable rates from 5.23 with a 3% fee, or from 5.24 with a 1195 fee. Now, interestingly, at the Landlord show I was at yesterday, we were talking about interest rates, and someone said to me, you're surely not actually arranging any mortgages for people with those really large fees. Actually, yes, we are. There is a place for them in the market, and they're not for everybody. Some people have an inherent dislike of big arrangement fees, and that is absolutely fine. But the large arrangement fees kind of serve two purposes. So the first thing is that the higher arrangement fee, as we've just kind of illustrated, buys you a lower interest rate. And some people are incredibly focused on cash flow. So that kind of really helps you there. And what you need to do is when you're looking at your mortgage options, look at the cost in the round. So if it's a 5-year fixed rate and your interest rate is 4.5%, but you're also paying a 5% arrangement fee, 5% divided by 5 years is 1%. So really your interest rate is 5.5%. If you were to take a rate with a lower interest rate, are you still attracting an overall blended interest rate as such, or is it higher or lower? And that's really what you need to look at. So be mathematical in your approach to this rather than emotional. If you want to be emotional about it and say, I'm just not paying it, that's absolutely fine. But in terms of best value, which actually is something I think we're incredibly focused on at the moment, that's how you would do your sums. Now, the other thing about the higher arrangement fees, because they buy at a lower interest rate, what this then allows you to do is borrow more per pound of rental income than if you were to take a higher interest rate with a lower fee. And because of the way the rental calculations are kind of landing at the moment, because of the higher borrowing costs, actually some people have quite simply no choice but to take one of those products. It's the only thing that where the numbers kind of metrics start to work for them. So there is a place for them. We are arranging them. Has anyone ever said, oh my God, I love that 7% arrangement fee? No, they haven't. Of course they haven't. But it is a means to an end. And actually there is very much a place for it in the market right now. And I do think we're going to continue to see these going forwards for at least the rest of this year and probably into next, until we start to see fixed rate pricing start to come down, hopefully. Now, the other thing that we've seen this week is Molo make some changes to their lending criteria, which are actually really good. So it's very refreshing to see that in a time when things aren't feeling terribly, sorry about the sun that's coming into my face, things aren't feeling terribly good. It's nice to see lenders taking stock, taking a moment to review their lending criteria and see how they can further support landlords. And Molo have done just that. So what they have done is they have increased the maximum number of rooms on a HMO, or the number of units on a multi-unit freehold block, essentially a block of flats for all intents and purposes. So they've increased from 6 rooms on an HMO to 12 rooms, and 6 units on a multi-unit to 12 units. That's quite a significant increase. Now that's putting them in terms of the market. All of the lenders who lend on HMOs and multi-units will go up to 6 rooms. But actually the number of lenders who go beyond that really starts to diminish. The most generous lender that we have at the moment in terms of their appetite for larger properties without moving to more sort of commercial lenders is Paragon. They can go up to 20 rooms or 20 self-contained units. And that's pretty lumpy properties we're talking about here on normal buy-to-let rates, which I think is just incredible. But actually it's great to see Molo revisiting things and coming back to their policy. And we are having lots of lenders who are contacting us at the moment saying, okay, where are the gaps? What are we missing? Where can we improve? So hopefully over the next few weeks, while I might be bringing to you joyous news of reduced interest rates, what I might be able to bring to you is some better lending criteria from our lending partners. Okay, I've just repositioned myself so I'm not getting absolutely blinded by the sun. Isn't it ironic? We moan all year about not having it, and the minute it comes out, we're either too hot or it's in our eyes. That's me I'm talking about, obviously. Now, in terms of the Landlord show I went to yesterday, it was really nice to go out and really just have a good old chat with lots and lots of landlords. The Landlord Investment Show tends to attract experienced investors and people who are very serious about investing. But the number of existing landlords at these shows is really quite overwhelming, and it's a very diverse range of people as well. So you have some people who have maybe just made their first foray into buy-to-let in the last few months. We have property developers there, and what we also have is landlords who've been around for many years, more mature investor, should I say. So it was really interesting to kind of just have a chat with everyone and see how they're feeling at the moment. Now, I was watching a panel debate, which is very, very interesting. And there was an audience of probably about 150, 200 people. And the first question they said to the audience, or asked of the audience, was how many of you are worried about the abolishment of Section 21? And I was really surprised that actually probably no more than 20% of people put their hands up. Now that really got me thinking about, actually, is the abolishment, we were always told the abolishment of Section 21 is really bad. It's going to make loads of landlords exit the market. But on the back of this straw poll, I did suddenly think, maybe it's not the bigger deal that everyone thinks it is. So I was just reflecting on it, and actually I've really cast my mind back to my own experience of ejecting my tenants from my property when they hadn't paid their rent. And the reality is that if they hadn't gone into breathing space, where my Section 8 had to be paused and restarted, the Section 8 would have been no slower than the Section 21, because the Section 21 still has to go in front of a judge. And the thing that causes the largest amount of delays is simply getting in front of the judge in the first place. So I really did think that actually maybe, while obviously no one's going to be pleased about the abolishment of Section 21, maybe it isn't as bad as we fear it's going to be. Particularly there's going to be other grounds brought in for eviction and other, the ombudsman scheme and this kind of stuff. So I did actually think maybe things aren't that bad. Now, another thing that was really interesting is they asked the audience, how many of you are worried about interest rates? And again, I thought that everybody was going to put their hand up, but actually only around 30% of people did. Now, this loops in very nicely to some of the conversations I had throughout the day. And when we were chatting to landlords, while some of them are obviously very, very concerned about the cost of borrowing, actually a lot of them are saying, do you know what, Jenny? We've just gone back to normal now. The average interest rate in the UK over the last 30 years is around 6%. We're currently at 5%. We've just gone back to normal. The last 10 years or so have been an anomaly, and actually we're returning to normal lending environment. Of course, people have got used to borrowing at those very low interest rates, but actually that's not really how things work in a healthy market. So that was kind of, I suppose, almost reassuring for me that the higher borrowing cost isn't driving the landlords out of the market in droves, which again, when you read some press, that's what you'd be thinking. Now, in terms of what landlords were planning to do going forwards, so interestingly, the question was asked, how many of you are planning on selling a property this year? There were a few hands that went up, but not many. Now, one could argue if you're at a landlord investment show, that kind of puts the onus on investing. So probably it might not attract all the landlords who are just thinking about selling off. But actually still, it was a smaller number than, again, you may be forgiven for thinking that it would be. Interestingly, the number of landlords who are planning to invest this year, it was around 40%. And the rest of the audience were really saying that we're just going to sit on our hands, let this kind of wash through the system. The rents are going up. Yes, mortgage costs are going up. Some of my portfolio are on lower fixed rates that I was able to secure a couple of years ago. So those will largely ride out this kind of curve. Yes, some of them I'm going to have to take new rates on. It's going to be more expensive, but I'm just going to really kind of sit back and watch and see how things shake out before I make any rash decisions. So I think actually what was really encouraging, and I always say this, but landlords are so incredibly resilient and robust. Actually, most people in the room are being incredibly pragmatic about all the kind of changes that are coming their way. I don't think anyone's celebrating any of it, but they're used to kind of watching the cycle, as it were, go around. And they're really just being incredibly pragmatic and just kind of sitting back and waiting for things to improve. Okay, now the very, very lovely people at Good Lord have done a survey on rents and are saying that the latest index reveals that England's rental market has caught fire, with rents rising for the 6th straight month in June and voids plunging. So in terms of rents, here's what they've got to say. Their survey found that 7 out of the 8 regions surveyed saw a surge in rent prices, pushing the average rent across England to £1,148 per property. That's a 3.3% increase from May's figures. Good Lord's Director of Insurance, a guy called Ollie Sherlock, said, "We've now seen 6 consecutive months of price rises and we predict this to continue throughout the summer." He added that we would likely see prices and demand peaking as we hit the start of the academic year, and whilst things normally cool down over the autumn and winter, if supply issues continue, we could see this pressure on rental stock continue, affecting all industry stakeholders. Now, the southwest region became the hotbed for largest price hikes in June, with rental rates soaring by a staggering 9%, jumping from 1,092 to 1,191. Now, conversely, the East Midlands was the solitary region that bucked the trend, witnessing a slight dip in rental prices by 1.08%. Now, what they've gone on to say is that the ongoing rises in rents has led to a 6-month rally, pushing prices to their highest point since September 2022. Back then, the average rents reached a high of £1,249 in September, which was the highest average rents recorded last year. So it just really kind of echoes what we've been, I guess, saying for quite a long time now. The rental market continues to be under a huge amount of pressure, and this is driving up the rents. Now, I appreciate that there are tenants out there who will be absolutely dismayed to hear that. And I think there are landlords who are working incredibly hard to try and ensure they're not pricing their tenants out of the housing market. But likewise, everybody's facing an increase in costs. And actually, if you're able to, at least in some way, offset your increased mortgage costs by an increase in your rental, then that can surely only be a good thing for landlords. Now, the survey went on to talk about rental voids, and what they've noted is that there is a big drop in void periods, which is another sign of strong tenant demand. So June saw an impressive 15% decrease in the average void period across England, shrinking it down from 19 days to just 16 days. Now, the southwest region, typically a moderate performer in terms of void averages, witnessed a remarkable decline in voids from 20 days to just 11, so a 45% drop. I'm not sure what's happening in the southwest at the moment. They're obviously going through a purple patch. The region is also where the shortest void periods in England were for June. Now, other big falls in voids include the northeast, the northwest and the West Midlands, with drops of 16%, 15% and 21% respectively. Again, the East Midlands experienced a 15% increase from 20 to 23 days, while landlords in Greater London saw a 16% rise, with voids going from 12 to 14 days. So, I think actually, again, short of having a tenant who is not paying your rent, probably the next most disheartening thing is to have an empty property when you're waiting just to re-let it. So hopefully this news will at least give some of you some kind of comfort in terms of how the rental market is continuing to be incredibly robust. Now, lastly, the mortgage charter was announced last week. So essentially what this is that the UK's largest mortgage lenders and the Financial Conduct Authority have agreed with the Chancellor a set of standards they'll adopt when helping and this is the key point here, regulated residential mortgage borrowers who are worried about higher interest rates. Now, what this means is that a buy-to-let mortgage is not going to be covered by these changes. Now, we know from speaking to some of our lending partners that they are already receiving calls from landlords who are saying, well, under the mortgage charter, can I have X, Y and Z? Unfortunately, this does not apply to you guys as landlords. I mean, I'm sure lots of you are mortgage holders on your own homes as well, so this is where this could come in handy, but sadly does not apply to buy-to-lets. So what the lenders have agreed is that anyone worried about their mortgage repayments can contact the lender for help and guidance, and without any impact on their credit file, and they'd encourage you to contact your bank, who are there to help. Support for customers who are up to date with payments to switch to a new mortgage deal at the end of their existing fixed rate deal without another affordability check. So essentially a product transfer. Now, actually, most lenders do this already. So I don't see this as any great shakes. And the lenders who have signed up to this, all the really large kind of institutions who definitely have a product switching offering. But it's great to see they've kind of formally committed to this. If they, before it was something they chose to do, now they have to do it. So that's really encouraging. Product transfers are wonderful, incidentally, because there is no underwriting, no valuation, no legal process. So actually you just literally can switch straight over to a new deal without going through any sorts of hoops. So for those people who are thinking on their buy-to-lets, for example, when I took a mortgage 5 years ago, the rental calculation was, pretty close to the wire at the time, and now things are moving. I might not be eligible, for example. If your lender does offer a product transfer, this could be a great opportunity or a way to kind of give yourself an option there. So do give us a call for a chat if you're in that situation. Now, the next thing is that lenders will provide well-timed information to help customers plan ahead should their current rate be due to end. So essentially, if your fixed rate is due to end on a residential mortgage, they're going to write to you with plenty of time to let you know that's happening. And also, I'm hoping at that point they're going to be advising you of the options that you would have available. Now, what they've also said, and I think this is probably the biggie, lenders will offer tailored support for anyone struggling and deploy highly trained staff to help customers. This could mean extending their term to reduce their payments, offering a switch to interest-only payments, but also a range of other options like a temporary payment deferral or part interest, part repayment. The right option will depend on their customers' circumstances. Now, if you are on an interest-only mortgage, unfortunately, there's not a huge amount you can do to drop your payments down because you are already on interest-only and extending the term doesn't make any difference to the mortgage payments. However, if you're on a repayment mortgage, extending the term is definitely a great option because it can just kind of shrink the payments down. Doing interest-only for a while could be a good solution. Also, going part and part could be nice. Now, when I was at the show yesterday, a very, very nice chap came to me and said, my daughter owns her own home. She is struggling because of the cost of living and she wants to make use of the mortgage charter and put her mortgage onto interest only. Will her lender let her do this? Now, reading the kind of wording in the last paragraph that I just read to you, it sounds like it's not going to be a case of, like with the mortgage payment holidays during COVID, where I think most lenders, you could just like fill out a form and say, I'm struggling, can I have a payment holiday for 3 months? And it just went through. It's very automated. It sounds like this is going to be much more kind of advisory. And so I suspect there's going to be lots of questions around your finances before you're eligible to actually make use of this charter. Now, I could be wrong here because I think it's going to depend largely on the number of people that apply for assistance. If the lenders only have received a few phone calls, then I think it's going to be quite a manual process. I think there's going to be people sort of doing checks. However, if they're absolutely swamped with people piling in, looking to seek assistance, then you may find that things move to a more automated approach where it's very much you can do it online, you tick a few boxes and away you go. So it'll be interesting to see. For those of you who do decide to switch to interest only on your residential mortgage, please, when you can, do so. Switch back to repayment. Unfortunately, when people get used to paying smaller payments, we live within our means, broadly speaking. They get used to those lower numbers, and then suddenly the switch back to repayment can feel incredibly difficult. And a lot of people conveniently forget to do it, and then they face difficulties down the line. So do just keep your eye on that. Now, the other thing that I think is just important to note is that from the 26th of June, a borrower will not be forced to leave their home without their consent unless in exceptional circumstances in less than a year from their first missed payment. So essentially, if you miss a mortgage payment and you continue to miss them and the lender moves into a repossession situation, they will ensure that you have to be able to stay in your home for a year from the first missed payment before eviction. So that also buys people at least a bit of time to get themselves either up straight or a new option sorted out when the eviction actually happens. So how do we feel about this? I think this is a really, really great thing. I don't think we can continue to expect the government to fix every single problem, and subsidising people's mortgage payments doesn't really feel very comfortable for me. So actually this feels like a good route to kind of help people kind of muddle through for the time being. If you are having any problems with your mortgage payments and your finances, do give us a call. We're very, very kind of open and sympathetic. We're very happy just to have a conversation with you. It's no problem. There's no expectation from our side that you're going to end up, transacting your mortgage with us at that point in time. So, do give us a call, 0345 345 6788. And that's me wrapping it up for this week. I'm not here next week. I'm actually going to be on holiday, which I should sort of act like I'm sad about, but I'm really excited. A week on the beach in Kefalonia feels very, very appealing at the moment. I'm tempted to not listen to the news even once while I'm over there and just have a break from the constant noise. So look, if you wanted to get in touch, we'd love to hear from you. I've just given you the phone number, but there's also loads of really fantastic information on our website, mortgagesforbusiness.co.uk. Have a good couple of weeks. I shall see you in a fortnight's time. Until then, look after yourselves.